Dignitaries on the days, dignitaries of the days. Very good evening, I should say. It's almost 4. It is already 4. And thank you for cooperating with us and having this marathon series of sessions. And now moving forward, we are having a very important session on RERA. And who better than Sunil sir to join us for this session. Again, a personality who needs no introduction, but I'll briefly introduce him. Sir is a highly accomplished chartered accountant and also a cost accountant. He secured AIR third rank and is known for his strong academic excellence with deep expertise in indirect taxation, GST, service tax, and international taxation. He has authored several accompanying books, including a comprehensive treatise on the service tax with 23 editions. I think 23 editions. Huge round of applause. Former president of Bombay Chartered Accountant Society, nascent trainer, and editor of BCA Journal. He is widely recognized as a thought leader and a trainer in taxation. With huge round of applause, again we'll welcome him, and I'll request team to have a memento as token of our appreciation. Request sir to take charge of session.
A very good evening to all of you. It's a pleasure to be here, and of course on a rainy morning around I think 8:30 or 9, Bishan called me to check whether I can come immediately, because I think the first faculty's flight was delayed. I said I'm at Andheri, it would still take me at least a couple of hours, and therefore it didn't work out. But one thing which I must appreciate is we just completed our CA Foundation Day, 1st July. And this type of a commitment on a Sunday, and we are having a full house of around 200-250 participants here Sunday evening with so much of rains. I think that commitment is so a loud round of applause for each one of you. Some of you might have navigated through the waterlogged roads and all. So I think that's really wonderful to have this type of a commitment, and I don't think any other profession has this type of a commitment. So we need to be proud of ourselves for this type of the zeal to learn. And I think that zeal to learn is what also excites me to be here at Borivali. I've been here quite a few times. It's like my second home. This auditorium itself, I've been here so many times. And when Bishan told me that why don't you take up the topic of real estate, this is one topic which again is very close to my heart. So I was very excited to take that topic, and maybe in the limited time which we have, we'll try to address some of the issues which are there. And this is one topic where you can just pick up anything and you'll find some issue. And for every question that you ask, I will have 2 answers. One answer would say it is taxable, another answer would say it is non-taxable, and I would be able to argue on both of them. So it's as controversial, it's as debatable. Every matter is pending somewhere in the courts. And I think the reason for that is this structure. The entire space of immobile property, you will find that there are multiple laws addressing this space of immobile property. And it primarily comes up from the Constitution. And if you go to the Constitution, you will find that immobile property is primarily a state subject. But certain facets of immobile property, like transactional laws, let's say Transfer of Property Act, is a central subject. And there are also various matters which go into the concurrent list, which is like RERA and all would go into concurrent list. So somewhere you will find that whenever you are looking at anything on an immobile property related transaction, there's always this classic divide or overlap. Does it constitute a state function? Does the center really have a power? What are the concurrent roles of each of them? And to add to that, we have one more layer, which is the municipal layer. So you have to keep that constitutional framework in mind as we go into looking at various situations and try to address the GST implications of that. Many a times we keep on talking about what about FSI. Now, before we really understand and take a position on FSI, we need to really understand what is that scope of the municipal function. And as we go into the specific things, we'll try to understand that and then try to analyze whether it really constitutes a regulatory function and therefore excluded from one notification. So that is one set of things, and when you look at that, you therefore have a set of laws, a set of regulations, set of regulatory authorities, all of them, and each of them having their own tribunals or courts interpreting and bringing in jurisprudence. Now, essentially, while their laws might be slightly different, some observations or some findings of those courts might again become very relevant when we are taking some positions in the GST law. Therefore, I think the canvas which we are going to look at and we have to examine when we look at any advisory in GST on the real estate sector will not be limited only to the GST Act. Essentially, if you go to the GST Act, except an entry in Schedule 2 and one entry in Schedule 3, there's nothing in the GST law talking about real estate. And if I have to just concentrate on those two entries, entry 5B and 5C of Schedule 2 and 3 respectively, it might be just 5 minutes job. But we are all aware that a series of notifications has created a levy and a law. And that's where the entire interplay will come in. And that's why all these laws which we broadly talk about will become relevant. We might need to look at some provisions of the Transfer of Property Act. Avinash talked about the decision of Aerocom and the GCCI. And of course, the GCCI is pending in the Supreme Court. The crux of that will come from the provisions of lease of immovable property in the Transfer of Property Act. We cannot look at the GST provision in isolation. We will have to link it with the Transfer of Property Act to really come to a type of a holistic conclusion. Contract Act, of course, is a fundamental document because consideration comes from there. Whenever we talk about rehabilitation area, we have to look at the Contract Act, the interpretation of the Contract Act, the consideration. Without that, we may not be able to really take a position on the valuation or the other aspects of the rehabilitation area. The next basket is very important, which is the developmental laws. Many a times we very loosely use the words FSI, TDR, and then somewhere try to impose some barters and things like that. But honestly, before we really advise, and even when you talk of FSI, there are strays of FSI. Those who practice in the real estate and RERA know that there are different types of FSI, and each of them emanates from a different type of a provision under the development control regulations. So those development control regulations, the municipal corporation laws, the SRA scheme, because there's a separate slum act which deals with the slum rehabilitation. Many of the properties being redeveloped today are on leased properties given by MADA or MMRD or bodies like that. So all of those regulations again will have some interplay when we are looking at the GST regulations. Various buyer protection regulations, most important one being RERA, because we are aware that the series of notifications under the real estate which came up in 2019, all of them link themselves to RERA. So a little bit of discussion around that may be important. And finally, the accounting and tax. And that is where I think when you look at accounting and tax, and more importantly GST, it will have to link and derive itself from all these multiple laws. And when you look at the sector from a business perspective, also you find a complication because there are multiple business dynamics. And of course, we always say that for any property, one of the most important thing is the actual physical location. So while you have virtual worlds, you have AIs and all those things, as far as property is concerned, it is clearly a physical location which is going to be the key. But at the same time, when you look at location, that location or the land itself has no relevance or has a limited relevance. What is relevant is also the developmental potential. Because as we are aware, each land may not have a similar development potential, and that development potential, certain things you can load, certain things you cannot load. Let us say you are adjoining a military area or a military establishment. That land has a very different type of evaluation as compared to a valuation land where you can load lots of FSIs, TDR and take your building to as many number of heights that you want. So that's where again location, development potential, both of them link themselves into a broad matrix and an interplay. At the same time, the business dynamics of real estate is such that there is a lot of negotiating power required, and there is a lot of patience which will be required. We are aware somebody will start looking at a land, enter as a landowner, I will buy a parcel of land, or I'll take some interest in a parcel of land. Maybe I will, have to have the patience to keep it for 4 years, 5 years, because there will be lots of inhabitants there. There will be some tenants, there will be some slum dwellers. Maybe there's an existing building already there. So you will have to start negotiating with each of them, and there is a lot of dynamics related to business, because if the builder also or the landowner shows a lot of desperation, naturally the costs will increase. So there has to be a lot of negotiation, and there are lots of emotional facets which will get involved into this entire process of negotiation and financing till the time you really, get the premises vacated. There's a lot which goes in both in terms of time, financing, and the patience involved in that. I think construction expertise comes much later. And of course, branding comes in because you have to ultimately market. So I think these different things come in, and that's where you have different stakeholders. It's not just a simple situation where, let us say, if I'm manufacturing ice cream, I will just set up a factory, manufacture ice cream, sell it. It's not as simple. There are so many dynamics, there are so many regulations, there are so many, and because of so much of dynamics, there are multiple stakeholders, and we are all aware about these different stakeholders involved in the real estate activity. Of course, at the center, and who is going to be typically your client, is your developer, and to some extent, maybe a landowner. But yes, when you look at a developer, he is at the center of this entire thing, interacting with everyone else, and ultimately holding himself out as responsible to the buyer. He is registering himself as a primary responsible person under RERA. And therefore, the first leg of relationship would be between the developer and the buyer. And thereafter, of course, he coordinates with all of them, and there are different types of relationships at different levels. We'll touch upon each of them in some time, but let's quickly go through the first relationship, which is the simplest of all, the developer-buyer relationship. And the answer to that comes from the first line in the GST Act, which I talked about, Schedule 2, Entry 5B, which sort of creates a dimming fiction. For some another day, we can discuss whether the dimming fiction can be done or not. But right now, we don't go into that. We just respect this entry, which says, construction of a complex intended for sale to a buyer, except where entire consideration has been received after the issuance of a completion certificate, is declared to be a service under Schedule 2. And these are the similar types of words which are used in the rate notification as well. And basis this, along with Schedule 3, which says sale of land or building subject to this entry is excluded from the purview of the supply of goods or services. The combination of these two entries gives us a very basic proposition under the GST law. And that proposition is to say that if as a builder, I am selling prior to the receipt of completion certificate, which in Bombay, we use the word OC. If we are receiving, we are selling a unit prior to OC, GST is applicable. If it is sold post OC, GST is not applicable. I think this is the fundamental starting point of our real estate taxation. Up to here, I think everyone is comfortable and simple. One common misunderstanding which many people have is that one of the rate notifications brings in a reverse charge mechanism which has to be paid on the OC date based on the value and the quantity of unsold inventory. Many a times clients get confused. They assume that on the date of OC, you have to pay tax on the unsold inventory as a tax. Please understand that there is no tax on the date of the receipt of OC. What you are paying is not an output tax on that unit. What you are paying is maybe a reverse charge mechanism on the inputs, which is your FSI, TDR, and the development rights, whatever are the defined inputs. On that, you have to pay the tax. If you are a plain vanilla landowner developer who has his own land, who does not load any external FSI, then there is no tax on the unsold inventory. So please don't confuse that there is indirectly a tax on the sold area after the OC. The demarcation under the constitution and under the law is very clear. Pre-OC, this declared entry comes into place and there is a tax. Post-OC, there is no tax. Now comes a couple of variations into this basic proposition. One variation which comes in Mumbai very commonly is that builders go in for a phase-wise construction and partial OC. So let us say if you are doing 2 towers, you will just, it's a single project, but you are doing 2 towers. And 1 tower is done. So you want to get a partial OC for the occupancy certificate for that tower, give possession to those many people who have booked in that tower, and then you continue the work for the other tower also simultaneously. Because these are all gated communities, there is a lot of phased development which keeps on happening. Will you recognize a partial occupation certificate? And my answer would be yes. For sales within that tower for which the occupancy certificate is already received would be exempted thereafter. For the other project, you will continue to charge. So essentially in these types of cases where you go ahead and get a partial OC, what you will have to do is you will have to actually go ahead and split your project into 2 parts. One part which is part A, phase 1, maybe you might say 1A, 1B, whatever nomenclature you want to give, but you will have to identify it in that manner, and you will have to, in that sense, go QA the specific unit, whether this unit has got OC. If yes, it is outside. If no, it is inside the purview of the GST. I hope I am clear about this partial OC concept. A couple of smaller points which come up is a situation where there is a second sale by investor. So as we are aware, many a times a person will buy a unit, agreement for sale is also done, but maybe the project will take 3-4 years and that investor's needs have changed. So maybe 6 months down the line, he sells the unit to someone else. So the question is, does the tax stick to the builder? Because builder clearly would pay that 5% tax as and when he is getting installments from investor 1. Now after some point of time, instead of investor 1, you will have investor 2, because he has sold the unit to investor 2. Is there a tax on investor 1 as well? That is one more question which many a times people are debating. My answer comes from this entry itself. If you read the entry, the first word of the entry is construction of a complex. As far as investor 1 is concerned, he is not undertaking any construction at all. He is merely an investor in the property, maybe for self-use or for as a financing activity, whatever it may be. But he is not undertaking construction intended for sale before completion. So when the first word itself is not attracted, the question of the tax flowing to the investor and he requiring to pay the tax does not arise. So according to me, there is no question of the investor ending up paying any tax on that transaction. One more area which of course we now have a decision from the Karnataka High Court is a situation where a developer has started the work. He runs out of steam and maybe 1 year down the line, he just says, when I have done part of the work, but I don't have money to continue. And therefore he sells his entire project to some another developer who says, okay, I'll come in as is various basis. Whatever you have done till now is done. I will do the further activities. And there will be some compensation or some model whereby the developer 2 will pay some money to the developer 1. The question is, what happens to this type of a transaction where developer 1 has done part of the activities, invested lots of funds, maybe sold some units partially, some part payments have come, etc. And now he is selling it to developer 2 and let's say he is saying, you give me 50 crores and now you take care of all these buyers and you do all the construction in future. Whether this 50 crores is liable for GST or not. And to address that issue, this entire facet of construction and pre-OC, both those words, the combination of those words has been addressed in this Karnataka High Court, because in that case, the precise argument of the department was that OC has not come. There is no completion certificate. And because there is no completion certificate, whatever is received by developer 1 is liable for GST. And the High Court says, no, you cannot address this situation in this isolation. You have to start with the word construction. Up to the date when the sale happened, the construction was done by developer 1 for himself. And the day he exits this scheme and he sells his entire project to developer 2, the construction is thereafter done by the developer 2 only. So there is no construction done by developer 1 for developer 2, and therefore there is no applicability of any GST. They said it is a part of the Schedule 3. Even partially completed buildings would fall within the exclusion under Schedule 3. So that's Rowan Corporation, which is a very important decision interpreting this situation. So having talked about situations where you are going to pay tax and where you are not going to pay tax, basis pre-OC and post-OC, this table of rates all of us are aware. Affordable housing is 1%, non-affordable is 5%, commercial is 12%. For residential, there is no input tax credit. Commercial, you get input tax credit if you are selling prior to the completion certificate. So that is, I think, the broad thing. And of course, there is something called as an ongoing project, but that's anyways, we are already 6 years into the scheme. So I will not go into that concept of ongoing project and spend too much time on it. We are aware about these conditions attached to the 1% or the 5% scheme. And the primary condition is that there is no input tax credit at all. Even if you have old balances lying in your credit ledger, you cannot use it. You have to necessarily pay these 1% or 5% in cash only. An important parameter is the 80-20 scheme. You have to make sure that at least 80% of your procurement is from registered persons. And if there is any shortfall, then you have to pay reverse charge mechanism on that shortfall. So that is, I think, the broad facet as far as the output tax is concerned. A couple of points on that, and then we straight away go into the relationship between the landowner and the developer and the development agreement and the situations around that. And this is again something which is coming up commonplace, is a situation where a buyer cancels his registration. And as we are aware, what happens is during the period of time, once the agreement is entered into, AFS is done, or even allotment letters, there are stage payments which the builder or the developer keeps on receiving, and he keeps on paying that 5% on a regular basis. Now suddenly 2 years down the line, the project is going to last for 4 or 5 years before OC. The buyer says, I want to cancel it, give me my refund. And there the question which comes is, what happens to the GST? Let us say the transaction value is 2 crores. 50 lakhs has already been paid. And on that 50 lakhs, 5% of 50 lakhs has been paid, which is that whatever the 2.5 lakhs is coming, has been collected by the developer and paid to the government. Now that person comes back and says, I want to cancel. Let's not talk about the valuation differences right now. Let us say the builder says, I'll give you back your 50 lakhs, no problem. You want to cancel it? Let's enter into a cancellation deed and I'll give you your 50 lakhs back. What happens to the GST component is a question which comes in. And the answer to that is yes, one may take a very clear view that there is a deficiency in service or a non-provision of service at the most, because essentially the service actually gets crystallized only on the date of completion certificate when you hand over the keys. And that is not happening here. And if that is not happening, clearly there is non-provision of service, so the GST could not have been charged. The problem comes is section 34, and we are all aware about section 34, which says that you can self-adjust a tax by issuing a credit note. But that credit note has to be issued within a specific timeline, which is the November of the next year. Now, if it's a long-term project, which most of the real estates are, you will find that you have already exhausted that window. And therefore, if you have exhausted that window, what happens? Let's say in this case, 2.5 lakhs was collected 2 years ago, and today he is doing a cancellation. What do I do with that 2.5 lakhs? The answer is, you cannot self-adjust it because of the clear mandate of section 34, but at the same time, the government cannot keep the money. There is a principle of unjust enrichment. If there was no supply of service at all, the tax cannot be retained by the government. So the tax becomes refundable, not self-adjustable against future transactions, but refundable. Either the builder can file a refund application as a supplier, or the buyer can file. And most of the places which I am understanding and I am discussing with the clients, in these types of situations, we typically pass it on to the buyer. That why don't you file a refund application? There's a detailed circular issued by the CBEC which explains the procedure in which the buyer can get the refund. Because the challenge which comes is if the builder wants to file a refund application, he will have to refund this first to the person. So, and then the refund, we all know how the department works. It will take 1 year or 2 years to get the refund. And if you don't get, then you'll have to fight in the appeals. So why should the builder stay invested for the tax component? So in most of the cases, the developer will say, I will give you the documents, I'll give you the proofs of payments, the chartered accountant certificate saying that this tax was duly paid to the government, etc. But as a buyer, please you go ahead and file a refund application and I will help you facilitate it. So that is a one specific facet which comes in. This I'll skip. So I think we'll go to the next basket. This was on the first relationship between the developer and the buyer, and I went purposefully a bit fast because and in a crisp manner, because it's not something which is very complex. Most of us have implemented it already. This is one area where we'll spend reasonable time on the landowner developer arrangement. And this is one area where there is one landowner for various reasons which we talked about in the initial part. They enter into a development agreement. There are variations of development agreements. There can be different structures in which this can be done, and effectively, in a very loose way, not in a legal way, both the parties become stakeholders or partners in the development of the property, and to some extent enjoying the benefits or the rewards of the property. But as we know, it takes various structures, and the structures ultimately lead to three broad, ultimately there can be combinations, but they'll lead to these three broad variations. And what are those variations? There is somebody who has an interest in the land. It can be a landowner, it can be a cooperative society, it can be anybody. It can be the government also in many cases. What in this partnership they do is they say that, okay, I am ready to put in or bring in this land or the potential into that. As compared to that, the developer, what he will do is, he will undertake all the activities, he will invest the money, do the marketing, etc., and construct the premises. Now, these constructed premises, there are two ways to compensate to the landowner. Either he gives money to the landowner, or he says, okay, I'll give you some amount of money and some amount I will give by way of some constructed area. So therefore, you have various types of deliverables by the landowner, either a land, partially developed land, or merely a development right. From the side of the developer, you will have either cash, either today, or variable. So there might be installments, there might be variable cash. There is something called as a revenue sharing agreement, where based on the revenue, some amount will be given back to the landowner. Developed area for further share, and then, as I said, share in gross revenue or share in profits. So typically, you have to look at this entire thing in two baskets. From the landowner's side, you have to check whether there is a land or a development right flowing, because if it's land, Schedule 3 is very simple. But if it's development right, we will have to enter into a debate of whether a development right is a subject matter of a service, or is it excluded from the Schedule 3 as a rights emanating out of land. And that's where we will have to navigate transfer of property and many other provisions. From the developer side, you have to just check two things. Don't go into too much of this paperwork or this nomenclature. Is the developer giving cash? Either today, tomorrow, fixed, variable. Cash transactions in money are out, so you don't have to worry if it's cash part of it. Or is he giving area? If he is giving area, then you have to ask the question whether there is a tax on that area, what is the value of that tax, and when is the tax to be paid. So I think these are the baskets which we will have to broadly look at in the next few slides. I hope I'm clear. If there's any question, it's a Sunday evening, so if there are questions, please ask them, otherwise it can become dry at some point of time. Please raise your hands at any slide. If there's a question, you can please ask them. So let's go to the facet of supply by landowners. And first, let's talk about the landowner side. And interestingly, the objective of the government in the Real Estate 2.0, which happened in 2019, is simple. Let us keep the poor landowner out of this entire GST compliances. So what they have tried to do is, to a large extent, they have introduced reverse charge mechanism to push the taxation on the heads of the developer rather than expecting the tax from the landowner. And I think in that sense, you might of late find that there's limited litigation at the landowner end. Of course, there are some sprouts of litigation which are coming up, and we'll come to those decisions in a few minutes. But the 3 points which we discussed: supply of land clearly excluded, Schedule 3, we talked about it. Partially developed, somebody does a bit of plotting and then sells it, or he has obtained certain permissions or loaded certain rights onto the land, and then he is giving it to another developer. I would believe that it would still stand excluded from GST under Schedule 3, and one can look at Rohan Corporation's decision. The third one is where we are looking at development rights under a development agreement. Now, a couple of points, and of course, in an earlier session, we have discussed this at other forums in much detail. Today, we may not have that much time. But before we really talk about taxing development rights. That's another thing, that the tax might be on the reverse charge mechanism or forward charge mechanism. We go into that slightly later. But before that, let's understand the subject matter of what do we mean by development rights. The word development rights, to the best of my knowledge, is not specifically defined under any statute. There are other definitions, transfer of development right and all, but the word development right by itself is something which the industry understands. It's not defined under any statute by itself, and through various interpretation of courts, judgments and other things, it has come to under a particular type of an understanding. And what is that understanding? One thing is very clear: the landowner, when he grants a development right to a developer, he does not transfer a title. That is very, very clear. The land continues to remain in the name of the landowner only. But what he gives, and this is where I think we need to read a development agreement, and most of the standard development agreements will say a few things together. It will say that, look, as a landowner, I am allowing you to enter the premises. I am giving you a license, and this is the word they use. It's a license under the Easements Act to enter into the premises for a specific objective. It's like I might call upon a maid into my house to clean the house. So there is a license which is given to the maid to enter into my house and clean the house. Same way, a landowner appoints a developer and gives him a license to enter into the land and construct the premises based on plans which also he will get approved on the name of the landowner. Now the developer will say, why should I do all this? Land is yours, I will construct something, it will become yours. So why should I do all this? And therefore, as a package, the second right which comes, the first right is the right to enter the premises and construct on it. Second, and the integral part of that right, is a right to market and sell the constructed area, which is allotted to the developer portion. So the constructed, so-called constructed area is divided into two parts, the landowner portion and the developer portion. So the developer portion, he is given a right to market and sell. Market and sell, then I could sell it as an agent also. So the development agreement further says that, okay, you can sell and keep the money with yourself. Each development agreement will use appropriate the sale proceeds to his own account. There will definitely be this word. That's not all. Along with this, there will be a power of attorney which will be given to our developer to carry on all activities required to do all these things. And finally, there will be a commitment in the development agreement that once all of these things are done and finally completion certificate is received, there will be a association or a society of the buyers, and the landowner says, to that society, I will give the conveyance. Means I will transfer the title in the underlying land. So all of these are deliverables within a single development agreement. All of us are aware about this, right? Now let me ask you a question. Can you have a development agreement where there is no commitment to give the title to conveyance at a future date? How many of you believe yes, there can be such an agreement? Value नहीं बचा ना फिर. Why will a buyer buy a property if he is not going to get a land title indirectly, directly? Right? So you have all these deliverables. You cannot split one deliverable from that. What is happening is the entire discussion in the space, in controversies, is about development right, development right. Does the landowner receive two payments? One for giving a development right and one for giving the title? Those who have seen a development agreement will find that there are no two separate payments. So, are we saying he is giving away his title in the land for free? is a question which we need to brainstorm. And if no, what it means is there are a set of deliverables under a single composite contract called a development agreement. And if there are a set of deliverables, the principles in indirect tax are very clear that you will go by the principle or the dominant object of that composite contract. Now, what is the most dominant object of this? If there is no conveyance, everything collapses, right? So therefore, the most dominant object is a conveyance, which is a transfer of title. And if that is the most dominant object, a development right gets subsumed within that subsequent future transfer of title. And therefore, the question to be asked is not whether there is a tax on development right. The question to be asked is that this development right has got subsumed in a future sale, and therefore it is excluded under Schedule 3. That is the line of argument which one would make to say that development rights are not a subject matter of GST. And of course, not directly, but indirectly in this manner, one will have to argue that. Another argument could be that in many cases, the landowner may not be into business himself. And if he's not into business, then the sale in the course or furtherance of business argument will suffice. Of course, when I'm saying this, two decisions which we need to bear in mind, and they are against decisions. Unluckily, these arguments have not come up in those decisions. The first decision is Prahita, and the second one, of course, is Shashi Ranjan from the, I think, Bihar High Court, Patna High Court. So both these decisions have said that development rights are taxable. Matter is pending in the Supreme Court, and therefore one will have to be slightly cautious about this broad argument, but this is an argument which one will have to look at. Now, moment if we say that yes, if I want to argue that it's not taxable, then I will fight it across the board. But assuming I want to be conservative, I don't want to keep on having an open position for 10 years, then what are the provisions? I think the provisions are clear. You have entry 5B, which prescribes reverse charge mechanism. So landowner actually is not too worried about it. It's going to be the developer who will have to really end up paying the tax under reverse charge mechanism. Naturally, if the tax is demanded on day one or the date of entering into the development agreement, the projects become unviable, and therefore there's another deferment notification. And that notification says that the entire tax will be paid on the date of completion certificate. Now, when you say there is a deferment notification, one important caveat is there. If you are paying a monetary consideration for a commercial construction, deferment is not available. The day you pay the money, you will have to end up paying the GST. But in general, if it's a residential project or if it's a non-monetary consideration, then you have deferment available to you, which means you will pay the tax on the date of completion certificate. The quantum of the tax also for residential, we are told that to the extent you have sold the residential units and I have received my 5% tax of under construction sale, I don't want to tax you. So there's a formula which says that the tax will be payable only to the extent, proportionate extent of the unsold inventory. This was what I was referring to in my initial part. And that tax itself is also capped up to the 5% of the value. So all of these you will have to go through, and accordingly on the date of completion certificate, you will have to make an Excel working. Nowadays I understand there are Excel charts clearly available wherein you have formulas to do all this. So you'll go through all of that, and ultimately on the date of completion certificate, the developer will end up paying on a conservative basis some RCM to the extent of the unsold inventory, basis all these very, very complicated calculations on this phrase. So that is the first part of the barter. As we said, in the barter there are two parts: development rights given by the landowner to the developer. We have talked about it. Bhale tax is to be paid by the developer. What we have talked about is the supply given by the landowner of development right. Now we are coming to the actual supply given by the developer to the landowner, which is in the terms of the area. Either if he is giving monetary consideration, then it's out. But if he is giving some area, let us say the construction is of 50,000 square feet, and he says 20,000 square feet will be given back to the landowner, who will independently sell this property. So landowner will sell his flats, the developer will sell his flats. So in this case, again, a general industry practice would be to invoke this para 2a, say that yes, there will be a tax. The tax again here has been given the benefit of deferment, so you will end up paying the tax only on the date of completion certificate. But there is a concession that if you want, you can pay it a bit earlier. Now, why would somebody want to pay early? Somebody would want to pay early because there is in this situation an interpretation issue on whether the landowner on his second sale is required to pay the tax or not. Now someone will come back to me and say, sir, in the investor example you said no tax is payable because there is no construction done by the investor. Will that argument not apply here? Landowner also doesn't do any construction. Answer is to an extent yes, but there is a bit of a difference between an investor and a landowner. The first difference is the landowner is in many cases also registered under RERA as a person who causes construction. That is one. Second thing is, if we refer the rate notification, there is a proviso in that rate notification which says that while generally we don't want to give ITC, but if there is a landowner promoter who is selling flats while under construction, he will be eligible to ITC to the extent of the output tax which he is paying on his further sale. So somewhere, of course, that someone can say that proviso cannot create taxation, and he would be right also. But most of the landowners, what they want to do is they want to say, as it is, if I collect and pay the tax, I am going to get the credit. So it's not going to be double taxation. But if I don't do that and 3 years down the line some officer comes, then it will clearly be double taxation. So landowners want to act a bit conservative on this. Though there can be a ground to say that there is no construction and I am not required to register and pay, most landowners would actually go ahead and register. They would collect tax on their end and claim the credit of the taxes charged by the developer. And that's how typically the provisions would work. It's also more practical because in the market, when the sale actually happens, it's the same towers. Half the floor is these guys and half the floor is of the developer. Both of them will market it simultaneously. You are a buyer. If you go to landowner and he has taken a position no tax, it means he will charge you 105. But if you go to a developer, he will charge you 100 plus 5 because he is going to charge GST clearly. There's no controversy on the developer's front. So that brings in a disparity. And when there's a disparity and confusion, brokers and everybody in the marketing field there would not understand this differentiation. And it can result in lots of what you can say trade disputes with the buyers and brokers and things like that. So to avoid that, I think generally the industry, the landowners in this example who are going to further sell, clearly would take a conservative position, collect the tax and claim the credits. So that's how it would flow. So this is what we talked about. Now comes the next basket. So we talked about a simple case. A landowner brings in his land. A developer does all the work, and we discussed all the tax implications. Now comes a variation, which is redevelopment. And we are all aware about redevelopment because I'm sure everyone has been exposed to some element of redevelopment activity, either in tax or GST, or at least as an end owner of a flat. And we have examined redevelopment in some manner or the other. So I don't need to explain you the scheme. The controversy in GST is simple. The society collectively owns the land. Society and the members collectively own the land. And there is a developer who comes and does the rehabilitation. The department's take is that this is nothing different than the earlier example of classic joint development agreement. In that, there was a landowner who brought in a parcel of land. Instead of that, here you have a society who is bringing in a parcel of land. And in that case, the developer gave back property to the landowner who would then sell it. Here, the developer is giving area to the members who are not going to sell it. That's all. That's how they equate. And in that conservative and analogy, we end up with answers which are similar. Okay, so if the department's case is ki whatever area is given to the members, let's say they originally had a 1000 square feet unit and you are going to give him 40% extra. So you'll give him 1400 square feet. they would apply the same analogy of this notification and say that on this 1400 square feet, on the date of completion certificate, take the first market value of the free sale area which you have done and pay me the 5% tax. That is the department's case. They use the same notification entry, the same para references, and say that there's a development rights, and against that development rights, there is this activity of construction services given by the developer to the society or the members. I have some fundamental problems with this approach. Its first thing is a joint development agreement is on a very different footing from a redevelopment agreement. So firstly, saying that a redevelopment is merely a variation of joint development agreement, according to me, is a totally incorrect legal proposition. Why am I saying so? Go back to the joint development agreement and we'll now use some names. So let us say A is a landowner, B is a developer, and there are C to H who are the end buyers of the property. In a typical joint development agreement, A will enter into development agreement with B, and as we discussed in detail, after C to H come in as buyers, they will create a society, right? XYZ society, and A will actually give away his title of land to XYZ society, right? That's what we discussed earlier. Now come to redevelopment. There is a society, there is B who is a developer, and after the completion certificate, tell me the title passes from whom to whom in a society. A Limited was the having the title prior to the redevelopment. A Limited continues to hold the title post the redevelopment and the completion certificate. So there is no transfer of title at all in a redevelopment project, and therefore they are fundamentally different. You can't compare them. In the first case, there was a transfer of title. Here there is no transfer of title at all. So whether a law which was intended to tax joint development agreement can be used to implicitly tax indirectly a redevelopment agreement for which there is no mention in the notifications, much less in the act, but even in the notifications there is no mention about redevelopment as an activity. Second important part is that if we refer Schedule 2, we refer the rate notifications. All of them use this phrase intended for sale. You will find it everywhere. This word intended for sale is also used under RERA. The applicability of RERA arises when you intend to sell units while under construction. And in the context of redevelopment, the question of whether a developer is required to register the area to be given to existing members under RERA was being questioned. And the tribunal has clearly, RERA tribunal has clearly held that for the area to be given to the existing members, members do not give any money to the developer. Also, there is no intention of further sale by the member, and therefore that area is technically not required to be registered under RERA. So if it is not required to be registered under RERA, if it is not intended for sale, and if the rate notification itself uses this word intended for sale, how do we use that rate entry and say that it becomes taxable? So I think that is one more facet which comes in. The third facet is the rate entry, the deferment notification. All of them use the word promoter. Promoter is as defined under RERA, and as we discussed a minute ago, that the tribunal decision clearly says that this area is not registrable, and therefore vis-a-vis that area, the developer is not a promoter, and therefore on that ground also one would say that essentially the tax is not applicable. अभी ये सब तो बहुत टेक्निकल बातें हो गया. एकदम सिंपल एनालॉजी इज this numerical example which you are able to see it on the screen, right? Everyone is comfortable with this broad financial part of what is being shown. This is how in essence it works, right? Developer will give 10 crores to the society plus some free area. He will incur 30 crores as cost for both the areas, free as well as saleable area. 40 करोड़ का उसका कॉस्ट है, 50 करोड़ का सेल है, 10 करोड़ का प्रॉफिट घर पे लेके गया. बराबर है, वेरिएशंस होगा लेकिन यही है, राइट? द क्वेश्चन इज कि ये जो प्लस फ्री एरिया लिखा है उसका टैक्स की हम बात कर रहे हैं. बट दैट प्लस फ्री एरिया का जो पार्ट है, इज इट नॉट अ पार्ट ऑफ 50 crores? Right? And that is exactly what Vasanta Green has said, which is a celebrated decision. Right? Which says, कि end of the day, GST is a tax on outward supply. This is not an RCM transaction. So outward supply is equated with my credits of my P&L account, not the costs. The free area which I give to existing members is cost. It's not my revenue. And that cost gets inbuilt into the new flats which are being sold, on which tax has already been paid. And if that tax has been paid, then my cost cannot become revenue, and therefore there is not a tax liability on this. So of course this is pending in the Supreme Court. As I said in my preamble, all the discussions which we are doing are going to have two answers. But yes, this is one judgment which I believe is a correct judgment and would have to look at it in future in a particular way. टेनेंसी, टेनेंसी में तो और भी एक इंपॉर्टेंट फैसेट आ जाता है. A tenant does not own the title. If a tenant does not own the title, can he even give a development right? Is a question which we have to examine. I can only give something which I have. So in tenancy and in slum rehabilitation, the question which comes up is, department will very comfortably say that, look, tenant, moment you entered into an agreement with him, it means he's giving you a tenancy right or he's giving you a development right. But if he never had anything, what is he giving me? Those are the questions which will come in. And the key point which comes in is the basic assumption of the department in all this is that there are no free lunches. And I think that is the fundamentally wrong assumption. In businesses, you can have free lunches. So if you refer any of these agreements, member agreement, tenant agreement, or a slum rehab agreement, these are not known as agreements for sale, firstly. These are colloquially known as permanent alternate accommodation agreements. PAAA is a commonplace word used. Each of these PAAs, if you read, they will clearly say that the area is given free of cost. You will find that most of the lawyers in those agreements clearly mention this as a phrase. The department wants to say, no. You are saying free of cost. But according to me, this is a barter. You are receiving some rights and therefore you are giving him. So essentially what the department is saying is, it is saying, I will ignore the agreement. Because I can see something happening, I will substitute the free word by a barter word. Whether the department can substitute words in an agreement is a legal principle which had gone up to the Supreme Court. In a celebrated case of Mahindra and Mahindra, the Supreme Court has said that unless one says that this transaction is clearly in the nature of a tax evasion and there was some undervalued or circumstantial money coming, you cannot redraft an agreement. You cannot ignore the terms of an agreement. So if the agreement says free of cost, the department may have to then bring in the tenant actually gave money which was not accounted in books, etc., and then argue. Without that, they cannot just say that, no, I don't agree that it's free. If you are actually giving free through an agreement, they will have to agree on that. And GST law on that is very clear, that if there is supplies for a nil consideration or a free consideration, then there is no GST applicable. And I think I have 5 minutes more, Vishan. So I'll take the last basket, which is relating to the relationships between the developer and the government. And I think one important concept which again is creating a lot of confusion is the FSI. and the tax applicability of FSI, how it works and all those things. Now, again, if you look at FSI, this is a word which has been defined, differently defined in different statutes. The UDCR clearly says FSI is the ratio of the built up area divided by the plot area. Simple definition, mathematics. Simple hai? This is what FSI is. When they say FSI2, what it means is अगर आपका plot 200 square meters का है तो आप 400 square meters बांध सकते हो. Right? This is what all of us understand as FSI. Right. Now tell me, from where does this FSI come? Let us say I have a plot of land. Does the land, can I build anything? No. Go back in history, कुतुब मीनार, उसको कितना FSI मिला था? The land regulation laws were not evolved at that time. Land always has a potential for development. It's like I buy a car. Today luxury cars, Bishan has a Mercedes. कितना स्पीड तक जा सकता है? 200? बराबर है, 200 किलोमीटर तक जा सकता है ना, कैपेबिलिटी है गाड़ी का. लेकिन वर्ली सीलिंग में जाओगे तो 80 किलोमीटर से ज्यादा नहीं चला सकोगे. बराबर. So that 80 kilometers comes from where? Regulation. Land has limitless FSI potential. The 2, 3, 1, fungible, whatever we are talking about is emanating because in the first slide we discussed constitution. There we said the state has a power to regulate development. And that power is then passed on to municipal corporations and a combination between state and municipal corporation. And therefore the government comes and says, Bishan, you can't drive the car beyond 80 kilometers. And then someday Bishan says, नहीं नहीं, आज मुझे इंस्टीट्यूट में जाना है, जल्दी है, प्रेसिडेंट भी आने वाले, तो आज मुझे 120 किलोमीटर चलाने दो. तो एज अ स्पेशल केस बिशन को बताया गया कि ठीक है, टुडे यू कैन ड्राइव एट 120 किलोमीटर्स. Potential of car was 200 kilometers. Is everyone understanding this? Through a regulation, it was reduced to 80 kilometers. Then, as a special case, that regulation was relaxed to say that, okay, today you can drive at 120 kilometers. So, whenever we look at FSI, हम लोग बोलते हैं अच्छा मुझे बेनिफिट मिल गया, मुझे ज्यादा बांधने को मिला. आपको ज्यादा बांधने को नहीं मिला, आपका जो एक रेगुलेट, जो आप ओरिजिनली बांध सकते थे वो रेगुलेट कर दिया था और वो रेगुलेशन में आपको रिलैक्सेशन दिया. If we position FSI as a relaxation of regulation, I hope I am clear of the concept which I am trying to bring in. And then read the notification 14, which says that if a municipal function is performed by a municipal authority, then it is neither a goods nor service. I think all answers fall in place. Are you getting what I am trying to say? अगर वो रेगुलेशन ही नहीं होता, पहला वो रेगुलेशन ही नहीं होता कि द स्टेट कैन रेगुलेट कंस्ट्रक्शन और डेवलपमेंट, अगर वो रेगुलेशन ही नहीं होता तो ये एफएसआई का झंझट ही नहीं होता जिंदगी में. ऑल ऑफ इट इज कमिंग फ्रॉम ए रेगुलेशन एंड देन दे वांट टू से कि ओके जनरली हम 1 या 2 का एफएसआई देंगे, फिर आप प्रीमियम देंगे तो मैं आपको थोड़ा सा ज्यादा दूंगा, आप कहीं स्लम रिहैबिलिटेशन करोगे तो उसका थोड़ा मैं ज्यादा दूंगा. बट ऑल ऑफ दैट आर रिलैक्सेशंस. Right? So if you look at it from that perspective, according to me, this is clearly a very strong case to say that there is no GST applicable on it. The last point which I'll touch is the lease premium. And of course, I'm sure earlier speakers have talked about it, even Avinash ji talked about it. The question of whether a secondary assignment of lease is by itself an element of service and whether that can be taxed. Detailed decision from the Bombay High Court, a detailed decision from the Gujarat High Court, both of them holding that these are rights in immobile property. There is no element of service and therefore there is no supply and no GST payable. Matter is in Supreme Court, as we know. Aerocom dismissal was an in limine dismissal, so it cannot be taken as a precedent. But despite that, Bombay High Court is in favor and Gujarat Chamber is pending in the Supreme Court, which will be finally deciding this matter. So I think here also clearly no tax comes into place. I think this we can skip, and this was all from my side. Thank you very much.
Thank you, friends. Before we start the last session of the day, I would request my colleague C. Ashwin Chotalia to present a very well-deserved vote of thanks to our learned speaker, Sunil Gabhawalla ji.
Thank you, Neeraj bhai. Good evening, everyone. I think सर का जो सेशन था वो बहुत बहुत ही ज़्यादा इम्पैक्टफुल था. जैसे टीचर होता है ना कि कुछ कुछ कॉन्सेप्ट्स छोटे छोटे ऐसे सिखा के जाते हैं, जैसे एक मेड वाला एग्जांपल दिया, अभी बिशन भाई की कार का एग्जांपल दिया. आई थिंक दिस इज सम ऑफ द एग्जांपल्स दैट हैज़ मेड, आई मीन वो आपको लाइफ लॉन्ग याद रहने वाले जब भी आप रियल एस्टेट के बारे में सोचोगे. सो थैंक यू सो मच सुनील सर for gracing and accepting our invitation, and on behalf of WIRC, I give you or would like to propose well-deserved vote of thanks on behalf of WIRC. Thank you so much. Thank you.
So, Sunil sir, because of your example of that car, actually Bishan sir was going to take a flight to Ahmedabad. Abhi wo car se ja rahe 200 speed se.